Fintech is basically startups using technology to disrupt everything that a bank does today. From payments to merchant services, to insurance, to lending, to everything. And we've seen in the last 5 years, great startups that have come, disrupted and created unicorns. Examples, take Paytm, EasyTap, FreeCharge in the payment space. You got Policy Bazaar in the insurance space. You got in the consumer lending space, Bank Bazaar. So everything that a bank does today is being disrupted by startups. But of everything that a bank does, lending is probably the most important and the biggest money earner for a bank. But it's also an activity that hasn't changed since probably we got independence. How many people here have taken a bank loan for a business or for yourself? Great. How many of you all thought it was, oh, that was a fantastic experience, almost like calling for an Uber? Yeah? No one, right? It was a pathetic, terrible experience. I used to run a family business in manufacturing. We were a relatively mid-sized firm. To get a loan from a bank, it used to take weeks, if not months. And that process has to change. Today, if I can buy a phone and a fridge online, why cannot I not get a loan online? And that's the reason we at Capital Float are really trying to disrupt the lending space. And within lending, SME lending is one of the biggest pain points within the country today. And why we believe right now is the right time for disrupting lending. It's because for the first time in India, you have a confluence of three things. Demand from SMEs for money, which is off the charts. Technology and capital, which are at an inflection point that is allowing companies like us to do good stuff and be actually disruptive. Let's talk about demand. There are over 30 million SMEs in the country today. They contribute to about 20% of GDP, 40% of jobs, 40% of exports. Right? We need them in our economy. The economy will perish without SMEs. But there's a huge problem. Of the $400 billion odd dollars that SMEs need in loans today, only a third is serviced by banks. What happens to the other $200, $300 billion that SMEs need today? They go to the Sindhi moneylenders, who are great at providing a quick service, but believe me they charge an arm and a leg for that loan, right? It starts at 30% and probably ends somewhere at 60%. And they are doing it because the banks have left the space wide open. Banks love to do the large ticket loans because their cost structures allow them to do the large ticket loans. The microfinance institutions, on the other hand, have done exceeding well when it comes to rural lending and giving loans less than 50,000 rupees in tier 3, tier 4 towns. Who is really solving the missing middle? That is companies from 50,000 to 50 lakh and the loans that they need. We all know that there are 250 million smartphones in the country. There are 300 million internet users, all growing very rapidly. But do we know this? A landmark that happened this year in Indian banking is for the first time, electronic clearances, that's RTGS, NEFT, NACH, etc., surpassed paper clearance. That's your check clearance. Can you imagine in a cash-driven country like India, electronic clearance has surpassed paper clearance. That's a huge, huge sort of milestone. More importantly, SMEs today, about 40% of them are on Facebook, 20% of them are on LinkedIn, 60-70% of them use WhatsApp and Google. How do we use that data to actually be able to give a loan? The net result of all this technology coming together is the story of one of our customers, Mohd Zeeshan, a travel agent doing about 20 to 25 lakhs of business a year, working on platforms like Make My Trip, Yatra, etc. In today's financial system, it's almost impossible for him to get a loan because he doesn't have the right set of financial documents, and that's like a heap of them that a bank requires. The bank doesn't want to do a small loan of 50,000 to a lakh of rupees, and he has no data that a bank can actually use. The funny thing though, however, is he has got a very interesting digital footprint. All SMEs, and rather many of them today, transact on e-commerce platforms. Like I said, many of them use Facebook, they use Google. This means that they are creating a digital footprint, and how do we use that footprint for lending? So what we did at Capital Float is we were able to give this person a loan in under 10 minutes, right from application to disbursement, all using a mobile phone app. And how we did that? He has to go to the Google Play Store, download the Capital Float app, select the loan amount that he wants. We then ask him a bunch of questions, some permission to allow us to read a few sets of data from his mobile phone, and I'll come to that in a minute as to what data we look at. But beyond that, we heard Abhijit talk about the India stack. We have used the India stack, which is the Aadhaar and the UPI infrastructure, to be able to do his KYC, which is Know Your Customer norms, electronically via the Aadhaar database, and did it in real time. He then sees a bunch of loan offers from us as a lender and other lenders as well. He enters his Aadhaar and eKYC data, and he's able to digitally sign the contract. So no paperwork, no collateral, everything e-signed right through the app. And finally, the last stage is money disbursed into his account in real time via the UPI network, which is part of the India Stack infrastructure. So how did we decide to give him a loan? That's the black box algorithm that we've developed, and a few other fintech lenders are developing this as well. Some examples of this are his online application form. I know what time he's applying. Typically, we see applications that come in between 1 and 3 p.m. and 5 and 8 p.m. have the best chance of getting a loan, right? So your focus is a business day, you're thinking about lending. But people who apply from 11 p.m. to 4 a.m., not saying they're the bad guys, but the chance of them getting a loan is fairly thin. If he enters the entire application in form of caps, that means literacy levels are a little on the lower side, harder to get a loan. We then look at, because our app is now on his phone, we are able to scrape his SMS data. So we are able to recreate his bank statements from the automated messages that a bank sends you at every transaction. We are connected into the credit bureau via an API, so we are able to then pull and see what the other loans that he have and how is he sort of paying them off. He logs into the app via Facebook, so I know how many friends he's got within the region. Is he well connected within the region where he says, or if he's from Bangalore, are all his network and friends in Bombay? What sort of comments does he post online? Is it more negative? Is it more positive? All these add towards his credit score. And lastly, we also include a portion of psychometric test, which asks questions such as, hey, if you were to win the lottery today, how are you going to spend that money, right? Are you going to spend it on rent, your kids' education? Are you going to go blow it up at a party, for example? That gives an insight into the integrity of this borrower. And all these forces working together, his e-commerce data, how much does he transact on Make My Trip or a Yatra, put together, create this digital footprint where I am able to give him that loan in under 10 minutes without paperwork, without collateral. Finally, what's allowing all of this to come together very seamlessly is we got the technology, we got the demand, but we need the money, right? Finally, we started to see VCs venture out of e-commerce. Roughly about $200 million has been invested in the last year to two into fintech lending startups in the country, and there are about 7 to 8 of them, both on the consumer side as well as the SME side. And why are VCs excited? VCs love to see big markets, right? It's a $300 billion opportunity. But what's really going to be captured by fintech lenders in the next 2 to 3 years is anywhere from $5 to $8 billion of lending through online digital platforms, which means not a single branch will contribute to this $5 billion of lending. And hey, this is India. We all love to sort of make sure our businesses grow. We love to make sure we have enough money to grow. Lending in the country is set to grow 5x in the next 10 years, right? And this is a direct factor into how the GDP of the country will sort of grow as well. And off that, you can see that SME lending has the highest growth trajectory in the next 5 to 10 years. What does all this finally mean? Today, the market caps of banks and NBFCs is roughly about 150 billion. Data and research shows that this is going to grow to about 600 billion in the next 10 years. And I leave it to you guys to sort of think and imagine who's really going to capture the lion's share of that 600 billion pie. Is it going to be the banks, the public sector banks, or is it going to be the new age fintech lenders? Thank you.